From the News Channel 5 Network, this is MorningLine.
Good morning, everyone. Thanks for joining us on MorningLine. I am Nick Barris. It is Tuesday, and we have a good show on tap for you this morning. As always, we're going to open up the phone lines and invite you to join in the conversation. But as often is the case when this special guest joins us, I think many, if you're like me, like to sit back and listen, because I learn from him every time he comes on. And that doesn't mean you can't join in the conversation. So we'll get the phone number there in a moment. But we're going to be talking about your money on a big scale in this country, investments, and we'll take your calls as well with our friend, investment expert extraordinaire, and guess investment coach. I mean, we can call you any number of things, but Paul Winkler, it's nice to have you on. And I do. Every time you come on, I learn something from you. You're a very smart guy. Sometimes I'm not going to lie. Sometimes you talk and it goes over my head. I'm going to say
We'll try to keep it simple.
You got to keep it down here for dummies like me. But I'm glad to have you on this morning. And
good to be here, man.
As I said, you see up there, we're talking about investments, money, and spending. And I always like to just get your take. It's been a few weeks.
Yeah, investors do really poorly. You know, people are dependent upon themselves for their own pensions nowadays, because pensions are gone. You know, those days are gone. But I find, Nick, you know, people make it complicated, but it's not that complicated. Let me just explain why.
Okay.
People go through a cycle psychologically around money. And if you were to say, Paul, what is the biggest reason investors get bad returns? And wait till I tell you what the returns should have been. Their new Dalbar numbers out.
Oh, okay.
Now, Dalbar is a company out of Boston.
All right.
And they don't just look at investor returns in mutual funds. They don't just look at the mutual funds themselves and say, hey, what are the returns of the mutual funds? You know, because a lot of times what happens when you're buying a mutual fund, they'll say that mutual fund has had a 10% return over the past 5 years or 10 years or something.
Right.
They look at what the actual returns of the investors in the funds have been.
Okay.
You know, what did they get investing in these funds? And it's really interesting because the returns are awful compared to markets. Really, really bad. Investors get awful returns.
Well, now what do you mean? Meaning that, give me an example.
Well, let me just give you the numbers.
Yes.
Over the 30-year period from 1984 to 2013.
84 to 2013, okay.
The rate of return in the stock market as measured by the Standard & Poor's 500, just the 500 biggest companies. What if I invested across the 500 biggest companies, didn't try to figure out which company was better than another.
Just put it in there?
When to get in, when to get out, didn't do anything, just bought and held that area of the market. My rate of return would have been 11.1% per year over that period of time.
Pretty good.
I'm going to get into what that means in a second, because most people hear 11.1 and it's just like, yeah, blah, 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 blah. Okay. But if you actually look at the rate of return of equity investors or investors in the stock market over that same period of time, the average equity investor, it's 3.69% per year. Is the rate of return that they actually got. So they didn't lose money.
But they didn't make anywhere close to what they could have.
But the return was way below.
Now, why is that?
The reason
because they're bouncing around and moving.
Well, the reason comes down to investor behavior.
Okay.
Now, people tend to, after the market goes up, they hear all the glowing reports on Wall Street and how great the market's doing, how great the economy is, and they go, wow, you know, the economy's good, the market's up, I think it's time to invest. And then all of a sudden what happens, they invest, and maybe it keeps going up for a couple years, and they're going, yeah, this was a good idea, this is great. And then all of a sudden the market goes down, and they go, whoa, this was not a good idea. I should have trusted my instincts. You know, the market's a bad place to be. And then they get out, and what they're doing is they're buying high and they're selling low.
I was about to say, exactly.
Now, they may not lose money because, like I said, they may get in, it goes up, and then it goes down, but it didn't go down as much as what they gained, but they end up with a return that's way lower than the market. Now, those numbers are meaningless to most people. 11%, 3%, it doesn't mean anything. If I put $100,000 30 years ago in the market, and I got the market return, well, let's go the other way first.
And you just left it alone.
Let's go the other way first. What did the average investor turn that $100,000 into? Just shy of $300,000. So they tripled their money.
Okay.
So most people look at that and go, that's not bad, tripled my money. What did the market do? You would have had $2.3 million if you had just gotten
put it there
market
and
returns.
left it.
Why? You asked why. The reason is this. People have a fear of the future. I'm scared to death. I don't want to mess up. I don't want to get too low returns. I don't want to run out of money before I run out of life. I keep hearing about, the political atmosphere in Washington. I keep hearing about the dollar crashing. I keep seeing the gold commercials that the crash is imminent. It's going to happen. I have a fear of the future. And what happens is because of that fear of the future, I want to predict the future. If somebody's telling me that gold is the way to go, if somebody's telling me that they predicted the stock market downturn of 2000, 2001, 2002, then I feel like that person is the right person to tell me what's going to happen next. Maybe they predicted that gold was going to go up and go back down. Maybe they predicted that tech stocks were going to go up and go back down. Any number of things. And I want to predict that future. So what I do, I look at who did it in the past. Who had the best past performance? And I look at star ratings. If I buy a 4-star fund or a 5-star fund, those funds get those ratings based on past performance.
Right.
But it doesn't work like every other area of our lives. If you're going to go, let's say, interview somebody, you're going to interview somebody that was maybe smart on some certain topic that you need more information on.
That's right.
If they were smart on it in the past, they probably are still smart.
I'm choosing an expert to talk to me, and I base that on their resume.
They're still an expert.
Okay.
Yet in the investing world, that does not work. Somebody that was really good in the past is not necessarily going to be good in the future. Matter of fact, you find that the people that are good in the past, there's a negative correlation. In English, they actually do worse in the future.
Well, if you're right about that, it sounds to me the fact that they were good in the past was dumb luck. Because if it was based on some form of skill, they're not suddenly losing their skill, so why doesn't it apply later? Is it really just dumb luck if they were good here, or bad luck if you tanked?
Well, evidence of that is when you have these people that throw darts at the stock tables.
Yeah.
Everybody's heard of it.
I know. Or the monkey that's picking the check mark in the zoo. It's not a
secret. Yeah, it's not a secret. It's not like, gee, Paul, you're saying something nobody has ever heard before. But what happens is because we don't want to believe this to be the case. We want to believe that the people giving us advice are actually experts and they really have these abilities because we desire that prediction about the future, you see? See how that fear of the future leads us to want that to be the case. I really desire that to be the case. Burton Malkiel from Princeton actually put it that way. He was asked. He says, why do they continue to do this? Well, they truly believe they can. It's not that that they're stupid. They truly believe they can.
Now, it's interesting when you say this, and I'm just thinking some of the viewers that are just thinking on the very basic plane like I am are hearing you say this, and they're saying, well, Paul, if that's the case, and really the average investor just has to think, all right, put it into something, leave it alone, why then do they need someone like you? And spell that out for them then.
Well, the reason is because our instincts drive us to do the wrong thing.
Yes.
And what happens is, I kiddingly said this. I was talking about, I was teaching a workshop not too long ago.
Yeah, all right.
and I was teaching our clients, right? And I was showing about all this terrible stuff going on in 2008 and 2009. And what I did is I had this one slide where I showed that I was rebalancing. I said, here's, at this point, when we were rebalancing a portfolio, which is, what I mean by that is, let's say if I have,
hold it up, you'll see the monitor. Yeah, just
there you go. Is that good?
Okay, all right,
okay.
Yeah. There you go.
Let's say I have half my money in this area of the market, half my money in this. Let's say that's area A and that's area B. And all of a sudden, A does very, very well, and B kind of meanders. It doesn't do so well.
Yeah.
Well, what's going to happen is my portfolio is not going to look like this anymore, is it? It's going to look like this. It's going to be overweighted in A.
Okay.
Maybe 60% of my money will be there.
All right.
B might be taking up 40%. Well, what I'm supposed to do, what most people do is they say, man, this A fund is rocking. That's great. So I'm going to buy more of it. And I'm going to say, no, I'm going to sell some of that, and I'm going to buy some more of this thing that didn't do so well, which is totally opposite of our instincts.
Right.
Our instincts say, go toward pleasure, go away from pain. So what happens is that we tend to do the opposite of what we should do. Well, one of the things I was pointing out in the workshop is I said, if you take a look at our portfolios, what I was doing is I rebalanced the portfolios at the beginning of 2009 when everybody thought the world was coming to an end. I actually sold bonds and we were buying stocks.
Yes.
And I said, you know why? And they looked at me and they go, wait, and I said, because it wasn't my money. And they laughed and they go, that makes sense. If you think about it, it's a lot easier for me to do the right thing because the instincts and emotions don't kick in.
Yeah.
And I was actually buying. And what happened is, from March until the end of the year, the thing I was buying went up 92%.
Yeah. So what you were doing was buying. I was selling rather. I don't know if it was high, but you're selling and buying very low, right?
And the reason you do it is to control risk in the portfolio.
That's what you were doing.
You control the risk in the portfolio.
It makes sense. Now, sometimes when you think it's not my money, you're doing it because you don't care. But what you're saying is you do care, but you do that because it takes the emotion out of it.
Exactly. Because you were saying, the reason I bring that up is you were saying, well, why do you need somebody like you? Because I can do something unemotionally, and I can do it less expensively too.
Sure.
You know, there's all part of that, and I'll watch it day to day. We watch it every day. But, you know, I kiddingly say that, but there's some truth to what I was saying, in that you are not, technically, people will not go and rebalance portfolios because it goes against every fiber of our desire to survive. I don't want to buy that thing that has just had bad performance. Back in 1999, another example, tech stocks were just knocking it out of the park. Everybody, because of their desire, I say everybody, most people, because of their desire to survive and get great returns, kept hearing about technology, technology, technology. Forbes was saying the internet was the safest bet around. So a lot of the experts were saying that this is what you need to be doing. So what do I do as a layperson? The experts are saying buy internet stocks. What do I do? Forbes says buy internet stocks. Hey, wow, they're a big reputable magazine. Buy internet stocks. And literally what I was looking at is going, well, you know, international small value stocks had a 0% return for 5 years. 0%. You know, people look at that and go, no way, I'm not going to touch that with a 10-foot pole. Yet over the next 10 years, when I rebalanced into small international value, that area of the market up 300 to 400%. And it isn't genius on the part of a person that does what I do. It's just doing what you know you should do, which is not when diversify by buying and owning a lot of stuff. Diversify by owning things that don't move with other things.
All right, take a break on that note. It's so interesting, and it just goes against your human nature, and you have to think it through and do what's right. Listen, take a break. Let's continue our conversation on that, and we'll get into some other issues as well. As I said, you can join us. You see the number on the screen, 737-7587. Questions, comments, philosophies on your investing, if you do so, or questions if you want to get to some basic stuff about Roths, 401ks. Feel free if you want to join. Paul's more than capable of answering any questions along those lines as well. We'll be back with more right after this.